Intercontinental Exchange Inc., stock ticker ICE, is an operator of global financial exchanges and clearinghouses and also provides mortgage technology, data, and listing services. Founded in 2000, but with certain roots dating back to the late 1700s, Intercontinental Exchange is now a $63 billion by market cap financial powerhouse that employs over 9,000 people. The company reports results across the following three segments: exchanges, 56% of fiscal year 2022 revenue; fixed income and data services, 29%, and mortgage technology, 16%. The company's most well-known offering is the New York Stock Exchange, which is the largest stock exchange in the world. It's sometimes hard for me to spend money, and that's because I'm aware of the fact that when I spend $1, I'm not really spending just $1. I'm spending more like $5 or $10 due to the opportunity cost of that money. If I spend $1, it can't be compounded into many more dollars. On the other hand, I do shop a lot and spend a lot of money on specific merchandise. That merchandise is high-quality dividend growth stocks. This is why the stock market is my favorite store, and that leads me right to the major exchanges like the NYSE. It's also what leads all other investors to the exchanges, but that's not all. Whereas many different types of merchandise can be simultaneously found at many different competing stores, this company has a lock on what it sells. The NYSE is basically a monopoly unto itself, which is why it's an irreplaceable asset and a crown jewel. If you want to buy any stock that is listed on the NYSE, that leads you straight to this company. And then you've got the futures contracts and clearing on top of it. As compelling as the story is already, Intercontinental Exchange has also bolted on high-margin data and technology services, leveraging their tremendous scale and built-in information. The recently completed $11.9 billion acquisition of Black Knight Inc., a premier provider of integrated technology, data, and analytics in the mortgage industry, only strengthens this aspect of Intercontinental Exchange. Intercontinental Exchange is in many ways dominant, and it's becoming even more dominant. This is why the company has such a long and clear runway ahead for more revenue, profit, and dividend growth. To date, the company has increased its dividend for 11 consecutive years. The 5-year dividend growth rate of 13.7% easily beats inflation even in the current environment. And you get the stock's 1.6% yield to start off with. That yield, by the way, is 40 basis points higher than its own 5-year average. The dividend is protected by a low payout ratio of 31.1% based on trailing 12 months adjusted EPS. Because of the low payout ratio as well as the growth of the underlying business, which I'll get into shortly, the dividend should continue to grow at a brisk rate for years to come. For dividend growth investors who prefer long-term compounding over immediate income, these metrics are highly desirable. Looking at business growth, Intercontinental Exchange moved its revenue from $1.6 billion in fiscal year 2013 to $7.3 billion in fiscal year 2022. That's a compound annual growth rate of 18.4%. Very strong. Meanwhile, earnings per share grew from 64 cents to $5.30 adjusted over this 10-year period, which is a compound annual growth rate of 26.5%. Extremely impressive growth here. However, I think we have to take both numbers with a grain of salt. Regarding top-line growth, the company has been actively acquisitive, which bolsters growth in absolute terms. In addition, that bottom-line compound annual growth rate is shown in its best possible light. Fiscal year 2013 GAAP EPS was unusually soft. In addition, I used adjusted fiscal year 2022 earnings per share, which is more indicative of the company's true earnings power. So the starting point and ending point is as favorable as it gets for the business. That's not to say that Intercontinental Exchange isn't putting up strong numbers. Rather, I wouldn't use the last decade as the most realistic baseline for building long-term growth expectations. Looking forward, CFRA is projecting that Intercontinental Exchange will compound its earnings per share at an annual rate of 7% over the next 3 years. In my view, that's fairly realistic. If a bit cautious, it's simply a better baseline for expectations on a go-forward basis. We can see that Intercontinental Exchange produced 8% year-over-year adjusted earnings per share growth in its Q2 fiscal year 2023 earnings report. That's just slightly ahead of what CFRA is putting forth. CFRA really hits home with this passage, and I quote, In a world full of uncertainty, we view shares of Intercontinental Exchange favorably as the company has an unprecedented ability to perform in all market environments. Not only was Intercontinental Exchange able to grow earnings before, during, and after the pandemic, but Intercontinental Exchange has seen earnings growth in each year since it went public in 2005. Furthermore, we forecast its mortgage technology business will continue to gain market share and create cross-sell opportunities. With the acquisition of Black Knight, Intercontinental Exchange has the opportunity to take a stranglehold on the industry by offering both standardized and customized products to its customers. Additionally, we are encouraged by Intercontinental Exchange's recurring revenue growth, which decreases the firm's reliance on trading volumes." Unquote. That's a very good high-level, long-term look at business dynamics. If we put it all together, a high single-digit bottom-line growth rate over the next few years would still allow for a low double-digit dividend growth rate. That's by virtue of the low payout ratio, which could easily but slowly expand at a very modest annual clip. What I see is a high rate of dividend compounding over the coming years, which is perfect for investors who can give those dividend raises time to pile up. Moving over to the balance sheet, Intercontinental Exchange has a good financial position. The long-term debt-to-equity ratio is 0.8, while the interest coverage ratio is nearly 4. That latter number looks troublesome at first glance, but that's mostly because GAAP earnings per share for the most recent fiscal year was artificially low. However, what I do find somewhat troublesome is how the company's long-term debt load has been climbing in recent years. It's basically tripled over the last 5 years alone, far outpacing the growth of anything else in the business. In my view, the balance sheet is becoming the weakest part of the business. Profitability is robust. Net margin has averaged 29.9% over the last 5 years, while return on equity has averaged 12.4%. GAAP earnings per share has been a bit lumpy over the last few years, which has negatively affected net margin, but this business consistently pumps out fat margins. That said, I'm surprised to see ROE so low in light of the balance sheet deterioration. What I see here is a great business with monopolistic economics and with proprietary assets, exclusive data ownership, and nearly infinite scalability of markets. The company does benefit from durable competitive advantages. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. The very business model lends itself to extra regulatory pressure, and the exchanges are very competitive with one another for new listings. The exchanges are global, introducing the company to currency exchange rates and geopolitical risks. The balance sheet is starting to show some signs of stress, and the Black Knight acquisition will only add further pressure to the situation, so it's incumbent upon management to ensure growth is worth the debt. The company's acquisitive nature exposes it to integration and execution risks. Any broad slowdown in the U.S. housing market could reduce demand for the company's mortgage offerings. A global economic slowdown would also negatively impact volumes across the exchanges. Although the recurring nature of that revenue would blunt some of the impact, these risks are worth bearing in mind, but the quality and growth potential of the business should also be part of the picture. Also, with the stock correcting in price since late August, the valuation should be part of that same picture. The price-earnings ratio is 20.1. That's based on trailing 12 months adjusted earnings per share. Is that an egregious earnings multiple for a company with world-class assets? I don't think so. We can also see how disconnected multiples are to their own recent respective historical averages. For instance, the price-to-sales ratio of 6.3 is well off of its own 5-year average of 7.3. The price-to-cash flow ratio of 16.7 is also quite a bit below its own 5-year average of 19.8. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a 2-stage dividend discount model analysis. I factored in a 10% discount rate, a 10-year dividend growth rate of 12%, and a long-term dividend growth rate of 8%. That initial dividend growth rate leans on the idea of slowly expanding the low payout ratio as the near-term earnings growth forecast falls short. I don't think it's an unreasonable expectation. After all, the company's demonstrated 5-year dividend growth rate is above this level handsomely, and there's not a huge gap between underlying business growth and this level of dividend growth. It's not a lot of ground for the business to cover. The one issue that does give me some pause is the balance sheet. Beyond that, there's plenty of quality and growth here. The dividend discount model analysis gives me a fair value of $127.21. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates ICE as a 4-star stock with a fair value estimate of $137. CFRE rates ICE as a 4-star buy with a 12-month target price of $135. I came out low, but we're all in the same general direction. Averaging the three numbers out gives us a final valuation of $133.07, which would indicate the stock is possibly 19% undervalued. Here's the bottom line, guys. Intercontinental Exchange Inc. is a great business with a crown jewel of an asset that every investor is familiar with, and the higher margin data services stand to make the business even greater. With a market-like yield, double-digit long-term dividend growth, a low payout ratio, more than 10 consecutive years of dividend increases, and the potential that shares are 19% undervalued, long-term dividend growth investors could be looking at a great chance to own equity in a business that they almost certainly interact with frequently. And now for a special news announcement. Philip Morris International Inc., stock ticker PM, just released an impressive near-term growth outlook. The company is calling for adjusted diluted EPS compound annual growth of 9% to 11% excluding currency from 2024 to 2026. In addition to the outlook, the company also raised fiscal year 2023 adjusted earnings per share guidance to $6.46 to $6.55 from the prior range of $6.13 to $6.22. This stock looks even better and cheaper after the revised growth outlook. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alert. I'll see you next time.